What we do at 10:40, I start with commenting on today's financial headlines. I started that way today. At 10:50, I do a 5-minute or 7 or 8-minute commentary. And then at 11 o'clock, Chris will remind me and we will start and talk. Are you ready for your meeting with your financial advisor? Most financial advisors meet with their clients. I got started before we were financial advisors, back in the days when we were stockbrokers. And back in the days when you were stockbrokers, at that time, stocks were in certificate form, bonds were in certificate form. And it was just during the period when they were beginning to register stocks and register bonds to keep them in a custodian. But a lot of people kept their own certificates, so that most people had 2 or 3 or 5 or 6 different stockbrokers that they worked with.
Mm-hmm.
And you never knew what a person had in their account because they didn't have accounts. They did have accounts, but you never knew what they had outside. In 1987, Merrill came up with the idea of financial planning. And the idea was to find out everything a person had and to move everything in-house. And that started a trend which has continued. Back before that time, back in the 50s and the 60s and the 70s and the early to mid 80s, stockbrokers never had meetings with clients. But when people began to charge fees, clients began to ask the question, why am I paying a fee if my account is down? And so started the meetings scheduled on an annual or quarterly basis. And I think that's true for most financial advisors. When you're paying 20% of your gains to a financial advisor, and when you're paying a fee, even if the accounts are down, most clients want to sit face to face, and now most advisors are there. And there's another aspect to it as well, because the big firms say, sell the relationship and not the performance.
Mm-hmm.
That's where we are. Anyway,
Mike, with that, I'll call your attention to the time. We are just at the top of the hour, maybe a little bit past. And so let me just say welcome aboard, everybody, and thank you so much for being here. Mike and I are grateful that you're taking time out of your day to spend it with us, and we're going to make sure that we bring you our absolute best. And Mike's got a great one lined up for you today with a bunch of information for you about getting ready to meet with your financial advisor and the questions that most investors never ask. For those of you who are new, my name is Chris Prouty. I'm here to moderate. I'm going to jump into the background in just a moment, but I am here keeping an eye on the webinar chat where I just sent a quick welcome message, and I will be there to moderate questions. When Mike has time to answer questions later on, I'll be relaying those to him from the chat, so you can feel free to ask questions there or in the Q&A. And Mike, with that, one of the things I just love about your presentations every week is how you cut to the information that is most meaningful. And I know today is going to be no exception to that. I'm looking forward to hearing your presentation today. And with that, Mike, I hand it off to you. Have a great presentation.
all right. So it is. Are you ready for your meeting? The questions most investors never ask their advisor. So we're going to cover that. We're going to talk about quarterly or annual reviews. We're going to talk about everything looks good syndrome. But the question is, are you asking the right question? And let me begin by saying, Adams Financial Concepts, we don't meet with our clients on a regular basis. We send out a quarterly report saying, this is how your account is performed. This is what you put in. This is what you've added or taken out. This has been the gains. And this is your ending value. And I shared some of the stories. You see people that put in 400,000 or 500,000 and are worth and have seen their accounts grow to 2.5 to 4.5 or 5 or 6 or more. This is what we do. We're in the process of merging with Family Retirement. New company will call be Venture Rise, and KJ Dykma started Family Retirement in 2018. I've been searching for a long time. I'm 82 years old, been searching for a long time for someone that can carry on. I will be signing a contract to keep going at this full time for 10 years because I love what I do and I do it well. But we don't do client meetings. KJ will do an annual meeting. Um, so usually what happens is for most of the people who are listening to this workshop are not clients. Those who are clients, they know that we've done very, very well. Um, anyway, my phone keeps ringing. Sorry about that. The idea is that most advisors, for people who are not our clients, spend a lot of time making and preparing for meetings with a financial plan. They want to make the client feel assured that the advisor is in charge and he's ready for whatever. Those plans are computer generated. Most investors simply go to the meeting, have a few questions, even go to meetings and don't have many questions. But I don't think that most people are asking the questions they should ask. So I want to lay out what I would do if I were in your situation. And the problem you have to recognize from the very beginning is the training that advisors go through. When I went through training, of course, as a stockbroker, we were doing stocks and bonds, but the same thing applies to today and the financial plan. So we were taught to answer the phone. If somebody said, "What's your opinion of AT&T stock?" And this is an actual example of what we were trained to do. But the response is not to tell them what you really think. The answer is to say, "Are you a buyer or a seller?" And the answer is going to change on what the person calling in, what the client is doing. It's by design, not an accident. If the person says, I'm interested in buying this stock, what you do is you say, "Oh, it's really nice. It's really great. This is the reason why you should own the stock." And you list 3 or 4 or 5 or 6 different things. If the person says, "I have the AT&T certificates," which is what people had in those times, because most people in the 80s had their own stock certificates. They didn't have it at a brokerage house. They had their own stock certificate. Very often the person would say, "Yeah, I have the stock. I own the stock, but I've been wondering if I should sell." Oh, you're absolutely right to think you should sell. Now, these are the reasons why it's a dog. The answer was all by design. Are you a buyer or seller? So as you go in to these meetings, understand that the advisors are well trained, that they're sophisticated, they're excellent at what they do in terms of preparation and understanding and building a relationship. Not so much in terms of how well they do in performance, but they're there to sell the relationship and not the performance. It's all by design. So the idea is when you go into the meetings is not to reflect how you feel, but to search for honest and real answers to know, are you getting the best advice? So I promise to you on this call is 12 questions that cut through the sales pitch. How to get real answers and not rehearsed responses, and what to do with those answers, and how to know if you're actually on track, and how to know if you're not going to outlive your money. That's what this is about. The idea is to ask real questions and don't give them the answers to what you think you would like to have. The idea is to write down the answers, to write them down. Don't get feedback. And before you make any changes, take them home. Think about the questions. Think about the answers. Think about the reality of what you've heard and sleep on it. You're really seeking advice, not validation of your feeling. Studies show that we go into situations and we listen to the information that will confirm our already expected answers. If you do that, you're not going to get to real answers. And you want to be sure that you're getting the best advice. I was going to add the question, are you giving me the best advice? But I already know the answer. Advisors are always going to say, of course, I'm giving you my best advice. That's what you're paying me for. So ask why. And remember the training. Always remember the training, that they're there to understand how you feel, and they're there to sell the relationship. They sell the relationship, not the performance. That's what they're doing. So the first questions you want to ask, am I on track to meet my goals? You want to ask about the short-term goals. Because if you have a financial plan and your financial advisor is doing a financial plan, you want to know if you're on track to meet those goals. Are you meeting your long-term goals? Am I meeting my long-term goals? Do I need to make changes? What changes do I need to make? Literally, that's why you're there. And you want to know very well if, according to that financial plan, if you're on track to meet the short-term goals, if you're on track to meet the long-term goals. And if not, what changes need to be made and when? That's where do you begin? And you have to think. And it's not a question to ask, but the question to be in the back of the mind all the time. Are you getting the best advice given your situation? Not just good advice, not suitable advice. There's two types of advisors. The registrations are different. For a registered investment advisor or an investment advisor representative, they were licensed under the Investment Act of 1940. They're fiduciaries. They have to make every decision in your best interest. Advisors at big brokerage houses, like the Merrill, like the UBS, like the Royal Bank of Canada, RBC, those advisors were licensed under the Securities and Exchange Act of 1932. All they have to do is give you suitable advice. And what that means is if they're recommending a mutual fund, and there's two mutual funds, one that has suitable performance or equal performance, one has a higher charge than the other, they can make the recommendation for one that will give them the highest fee back to them rather than the one that will give you the lowest fee. What you want to do is to get to the best advice. You need to know if your advisor is a fiduciary or if they work for a big brokerage house. And you want the best advice. You want to have in the back of your mind all the time, not a question, but to know what the best advice is. Find out what it is. So let's begin. The questions that most people don't ask is, what has been my actual performance? How have I done in the past? Looking to the future, I want to know where I want to go in the future, but what is my actual performance? I want to know what the dollar amount is that I started with and how much has it increased? What did I begin with? How much did I add? How much have I taken out? What have been the gains? And what's my ending value? I want to know the dollar increase. I also want to know what the compounded annual percentage increase is. Am I getting a 5% return on my money? If you're only getting a 5% return, why not put it into CDs where you get the backing of FDIC? even if you have to go to half a dozen different banks so that you don't pass 250,000 at any one bank. What is the annual increase? And if you're getting a 5% return on your money, think about it. The advisor's getting paid 1%. So the reality is your account is earning 6%, and the advisor is taking between 15 and 20% of your return. You know, ask what the annual percentage is and find out what the individual classes are. Most advisors are going to show you asset allocation. They're going to tell you that when one thing goes up or when one thing goes down, others will go up. That's not been true in the dot-com crash. It was not true during the Great Recession. Wasn't true during the COVID crash. But ask what the performance of each of those classes are. And how do they compare to the benchmark? You want to know. And you want to know how your account compares to the Standard & Poor's 500 with dividends reinvested. It's the most difficult. People compare their accounts to the international index because they have international stocks in there. It's always that performance over the long term has been less than the Standard & Poor's 500. Yeah, you can find other things that increase more, but the Standard & Poor's is pretty standard, and it's based on how well stocks in the US and how well companies in the US are. You should ask that. What's the dollar increase? What's the compounded percentage increase? And what's the individual class that you have in my portfolio? So that's the first set of questions, and look for answers which aren't realistic. When somebody says you're doing fine, that's not a real answer. Beating inflation is not enough, especially if we go into stagflation. Beating inflation becomes a very difficult thing to do. And each asset class should justify its place in the portfolio. The Standard & Poor's 500 is a reality check. They may not have immediate answer. If they don't have immediate answers, that has to be a red flag for you. You have to wonder if they're really prepared. If they just prepared a computer program and are taking what's going, but they're not really putting thoughts into it. But those are the beginning questions. You want to know what happens if things go sideways, if things get out of hand. What if inflation increases significantly? You want to know what happens with your plan. What if there's a recession? What happens with your plan? Saying you'll do fine, just hang in there, is not a real answer. What if there's stagflation, where you have both a recession and inflation? What if there's another great recession? We lived through one in 2008, 2009. What if there's a black swan event like COVID? I think these are questions you need to ask and you need to get answers to. And if they can't give you an answer, you need to know. And not only should you be asking those questions, you want to know what they actually did. What did you do in 2008-9 during the Great Recession? Most people that have been advisors have been around for that period of time. I hope you're dealing with someone that's been around at least that length of time if you're not one of our clients. What did you do during the 2008, 2009? Did you simply say, I'm here to hold your hand? I'm here to get you through? What did you actually do? Did you evaluate? And it may be that they didn't sell anything. We made a couple small changes during that period of time, but by 2010, we were hitting new highs with our clients. The market didn't hit new highs until 2011, so we were ahead of the game. What did you do in 2022-23? We had the inflation spike. Inflation went to 9%. What did you do in your accounts? It was a tough time for our clients. We're just now really seeing, and just in this year, seeing a complete recovery and new highs. We're getting up. We're again beating the Standard & Poor's 500 over the long term. Through the third quarter and through the fourth quarter, I'm sure we'll be maybe as much as a percentage compounded over 20 years. Ask them what they did during COVID. What did you really do? Did you sell out? Did you keep going? How did it work out? In each case, how did it work out for your clients? What would you have done differently? You want to know what they've done differently. Because past behavior predicts future behavior. We're taught to say past performance does not guarantee future performance. That's really true. But past behavior predicts future behavior. You should be asking these questions. There's a comment, and you should know as you go into these meetings, advisors want to sell you the relationship, not the performance. But what really matters? Are you trying to go in and make a new friend? Are you trying to become really, really good friends with your advisor? Or do you want them to really do well with your finances? Josh Byrne wrote a book called Backstage Wall Street. You've probably seen him on TV. He's on CNBC. Wrote the book saying that, and this is the quote from the book, most of the financial advisors I know and have met over the years are phenomenal, world-class salespeople. But a great many of these security selling savants don't attain the knowledge necessary to actually accomplish anything for their clients. Selling one's expertise is much easier than actually developing an expertise, especially as it pertains to investing. They're there. They've been trained, and most are extremely good at selling the relationship, not selling the performance. That's what we're trained to do. That's what the training was to do. I happen to be very different. I came out of a different time when if you didn't make money for clients, they didn't buy stocks or bonds from you. And that's carried over to what I do during all these times. We were trained as advisors. We were trained to give you the answer you want because we know that you come into the meeting expecting a certain thing. You come in with your own perceptions, with your own background, with your own experience, and what you hear during the meeting will either reinforce those or will raise red flags. But most people will look and listen for things which reinforce your own feelings. If you're feeling that things are going to go well, you'll hear that. And advisors are going to tell you what you want to hear, not what their real opinion is. That's true of a lot. They're really good at selling you on the relationship. And they may or may not have the expertise to back it up. Your job going through this is to get to the real answers, not to the sales pitch. So watch. There's red flags to watch out as you're going through this. Are you getting vague or evasive answers? That's pretty obvious. If you're getting a vague or evasive answer, what did you do? How are you looking forward? How are you going to deal with stagflation? How are you going to deal with another great recession? If you're getting a vague answer or an evasive answer, you got to ask the question, are you getting real advice? Is the person really on top of what they're doing? Or are they just putting information into a computer program and selling you on what the computer says? Not what they think, but on what the computer says. If they can't provide the quarterly performance data, you got to ask why. They may not have it at hand. They might have, truly, they might have to either generate it, or they might have to come back to you within a day or two. But they should be able to come back to you soon, giving you the performance. What did you start with? How much money did you start with? What have you taken out? What have you put back in? What have been the gains? And what's the ending value? They should be able to give that to you by a quarterly basis for sure, if not an annual basis. They should be able to say that. They should be able to tell you what your percentage, compounded performance percentage is in your account, and what the Standard and Poor's 500 was in that same period of time. If they don't have a clear strategy for what's going to happen with stagflation, if they don't have a clear strategy for what they're going to do and the changes that are going to be made for inflation or a great recession, it's a red flag. What are they going to do? And one thing that can be said is we're going to hang in there. The fact is, at Adams Financial Concepts, we know there's going to be setbacks. We know there's going to be calamities. We know that we're going to go through those tough times. You can look at the graphs of client performance and see we had a big surge up, we had a big surge down, we're surging back up again. We made a few changes during that period of time, and we're in the process of probably making another change soon in our client portfolios. But we have a strategy. We know what we're doing. We know the stocks intimately that are in our client portfolios. We can tell you why we own those stocks. It's not that this is a Morningstar 5 rated mutual fund. This is a Morningstar Gold rated thing. This is a Lipper rated thing. We can tell you what the exact stocks are, why we expect them to do well, and what's going on. Watch for defensive responses to questions. And pressure to make immediate decisions, not to say, to be vague with your answers, but to get a real answer. For me, the sign of a quality advisor is to give clear, specific answers. We do stocks and bonds, straight up. We don't do mutual funds. We don't do the structured notes. We don't do a lot of those things. My clients can ask me, why do we own this stock? And I can give them a clear, precise answer over what the stock is. And I can give them some idea of a target price which could continue to change. The stock that was in our portfolios the longest period of time went in 1993. Bought it back in 1993 at 10 to 12. It split 2 for 1, split 3 for 1, split 2 for 1. Bought it at 10 to 12, so the cost basis was 87 cents to $1.02. That stock we started trimming back at 100 in 2018. Still own a little bit of the stock in portfolios, but we started cutting back. We've had the other side too. I can't say that we haven't had that we haven't had downturns. At a stock we bought, I used the similar type price around 10 to 12, 14. Bought the stock, had great hopes that it could grow 10-fold, 15, 20-fold. The stock, in fact, went up and down and up and down, but around the same price. They changed management. The management came in with a different focus, kept going things. The stock didn't do that much. Changed management again. And the third time they changed management, I said, I'm out of the stock. We took a loss on the stock, having held it for 4 or 5 years. So we don't pick everything that makes a lot of money, but I can give you specific answers as to why and why I expected, even in the dog that we had, why I expected it to do well because it was in an area which had huge growth potential. They just couldn't execute. But I can provide actual data. I can have a documented strategy for various scenarios. I can tell you what we'll do in stagflation. I can tell you what we'll do in inflation. I can tell you what we'll do through a great recession. You know, your advisor should be able to answer tough questions, not avoidant, not general, but really answer questions and give you time to think. So this is what you need to do. Use the questions at the next review. I would guess that most people that are listening to this have not asked those questions and have not thought about those questions. And if anything in that gives you a concern, look for a second opinion to see if the answers come out from someone else. You're in the driver's seat. It's your money, it's your future, and they should be your questions. It's not about selling the relationship. It's about understanding what the performance is. Where have you been? Where are you going? And why do you think you're going to get there? And if you've had a performance of 5% and suddenly somebody says, we're going to be 10%, you have to ask why. It's your money, your future. You hire an advisor. That person is an employee of yours, not your friend. You should hire a person that's competent and quality. So with that, let me share where we've been. This is where we are. Through the third quarter, we've averaged 15.94% for our clients. The Standard & Poor's is at 15.9. That means a $500,000 account grew to 5.4 million. That's where we are. That's taking the data from clients' accounts, and we hire a third party to do that. They take the data from Interactive Brokers, where we house our clients. They take the data day by day, they compile it, they put together a report on a quarterly report for our clients. And that information is compiled. So it has conservative, moderate, and aggressive accounts. It's all compiled together. And we do this. That's the amount our clients are experiencing net of all fees, cost, and expenses. So the fees we charge are all taken out of that. So this is net to the client. That's the net growth they've gotten. We compare ourselves to the Standard & Poor's 500 because that's the hardest index to beat. We also sometimes compare ourselves to how is the average financial advisor doing? And this is where we show. I don't have data going back before 2008, actually before 2009. But this is how the Adams Financial Concepts clients have done. This is what the average financial advisor has done. We put those out, we publish those. Now, one thing that we do is we really do publish. We stand up to that. We put our money where our mouth is. I guess that's a bad phrase, but this is what we do. The average financial advisor, those are based on studies that Investment News does, Schwab, and BlackRock. All that information, Cerulli, and in the beginning, we had an estimate. But that's where we are. That's what's happening. And of course, we always have to say past performance is no guarantee of future performance. Go on our website and look at the disclaimers. I should read the disclaimers, but I won't take that time. That's where we are. I suggest you ask the real questions. Know whether you're going to be on this curve or if you're on this curve. And where do you really want to be? This was a big surge up. I can tell you we would have made some changes, so we would not have seen the downturn. Will we still have those things? A higher performance is always going to have higher volatility. Was that too much volatility? Maybe. But our clients are here. Our clients have a much better chance of not outliving their money than the clients down here. Anyway, maybe that's a sales pitch too. Anyway, it is what it is. And with that, I'll say questions and discussion. What are your thoughts? What are your feelings? Put them into the chat.
Hey, Mike, I'm back, and hello, everybody. Mike, that was awesome. So everybody, it's Chris Prouty. I have returned, and I am here to moderate and answer any questions that you might have. I can certainly relay those to Mike. So you have two different ways of getting those questions to me. You can use the webinar chat, or you can send them in the Q&A. If you do happen to use the chat, just know that unless you send them specifically to the hosts and panelists, everybody will be able to see your question. So if you have something private that you want to say, it's a good idea to put it into the Q&A. So we'll just give a second for any questions that might come in. Mike, somebody says if my advisor won't answer these questions or doesn't answer them the way I want them to, how should I proceed? I guess they're asking what they should do if they feel like they're getting.
If you take your car into a car dealer and they can't fix it, would you take your car back into that?
Well, that's a good point.
I mean, next week we're going to talk about what do I need not to outlive my money. It's your money. It's your journey. It's your future. It should be something you want real answers for and feel comfortable with the answers. Not going into the meeting with preconceived ideas, not going in but really listening to what the person has to say.
That's a great point. Everybody, while you're here, and if you happen to be typing your questions into the chat, I just put two different links for you. The first link I put is a link to the YouTube channel where these podcasts are produced and released generally by Monday of the following week. You can find this there, and you can find that under the handle About Money Radio, or you can just click on that link. And if you do happen to click on that link, we'd appreciate a subscribe to the channel. That helps us reach even more people with this valuable information. And then the second link that I put in was a link where you can email Mike if you'd like to. Mike checks, reads, and responds to every single email he gets. And if you have questions that you don't feel like asking here, you can send Mike an email at the address there just by simply clicking on it, and that will open up your email program, and you can then send him that email. All right, Mike, I'm checking in on the Q&A. I don't see any other questions that have come in just yet. We still have a very full room, so if you guys have questions, ladies and gentlemen, if you have questions, now is a great time to ask.
Either I bored everyone or I put them to sleep.
Oh, maybe you just answered all of the questions in the conversation, Mike.
Anyway.
Mike, somebody says, if I don't have a regularly scheduled meeting with my advisor, is it okay? Should I be reaching out to them for that meeting?
So that depends upon your advisor and how you feel. We have people that want to talk to us on a regular basis, and we do. We have other people that drop in from time to time and just to talk about things in general. It depends upon what you want and what you feel comfortable with. It also depends upon your advisor because advisors classify their clients. There's a big push on to classify clients as A plus, A, B, and C clients,
Mhm.
um, all based on how much revenue a client generates. So if I had the classification from another firm that was pretty close to the same size as ours, and their A plus clients were people that had, I think, 4 million. Their A clients had, maybe I'm off on the numbers. The A clients had 1 million. The B clients had 500,000 and could get up into the $1 or $2 million range. The C clients had 500,000, and that was the most they were ever going to have.
Mm.
And they had different classifications. For somebody that was an A plus or A client, they met with on a quarterly basis. They hand carried things to their CPA. They invited them to events. They did a lot of things to smooth uh, their clients. If you were a C client, one meeting a year, uh, they would call you on the phone another time during the year. They would email your tax documents to you, but it was a minimum amount of service. We love $500,000 clients. Let me say one more thing about how we calculate our performance. The standard in the industry are what's called GIPS, the Global International Performance Survey, or anyway, I can't remember the exact uh, what they stand for. But it's based on an internal rate of return. And when it's based on an internal rate of return, it means that the bigger the account, the more weight it has in the average. So if you have $1 million account that's earning 10% and a $10,000 account that's earning 5%, the average will be very, very close to 10%. For what we do at Adams Financial Concepts, eventually to be Venturized, is that we use a time-weighted average, which means every single account gets exactly the same weighting. A $10 million account's going to get the same weighting as a $1,000 account. And we don't have $1,000 accounts except for grandchildren. Anyway, but that means the average of those two, if the $10 million account is 10% and the $1,000 account is 5%, that means we report 7.5%, not close to 10. So that means that we focus on every single account, whatever the size it happens to be. That's not true with GIPS. GIPS gives a greater performance to larger accounts than smaller accounts. That's the way the industry goes. Those who have more money get better returns. Not here.
Thanks for that. Thanks for that, Mike. Mike, I have a question. Can you tell us the topic that's coming up next Thursday?
Next Thursday, how much money do you need so you don't outlive your money?
Mm. Hmm.
47% of Americans are more concerned about running out of money. They're concerned about dying. They're more concerned about running out of money than they are about death. I think that says something about where we are, what's going on in the economy. So, how much do you really need not to outlive your money? We face some storms, things that have never happened before happen all the time. How much do you really need?
Well, I'm looking forward to that one, Mike. Mike, I don't have any more questions queued up. So, with that, I will thank everyone for being here today. Really grateful for your time. And we'll look forward to bringing you another episode next Thursday at this same time. So, keep an eye on your email for an invitation to that. And as always, Mike, you get the final word. Oh, Mike, we just got somebody just said a great job into the chat. Thank you very much. Very nice of you. Appreciate that.
Thank you.
Mike, you get the final word.
Have a wonderful week. Happy New Year. And may 2026 be an excellent year. May you have great health, wealth, and happiness.
Hmm.
And happiness is probably more important than the others. But anyway, have a happy new year. And with that, I'm signing off.
See
Bye
you
now.
next